I think we have a different narrative. Now we're thinking about how do we make sure our quality of life is improving over time, or at least stable over time, despite climate change that is inevitably happening, right?
Welcome to this episode of The Future We Build. We're all aware of the sizable challenge facing real estate and the built environment: generate value whilst reducing impact. Today's guest sits at the intersection of that problem. Rahul Parekh is a partner at 2150, the venture capital fund created by NREP, one of Nordics' largest real estate investors. Now under the Urban Partners brand, a 20 billion platform that combines real estate capital with venture capital to accelerate the adoption of climate technologies in the built environment. Rahul just closed 2150's second fund at 210 million euros, bringing them to nearly €500 million to deploy in what they call gigacorns, companies with the potential to remove gigatons of carbon while generating financial returns. But here's the tension. Venture capital needs 10x returns in 7 to 10 years. Real estate moves slowly, procurement cycles are brutal, pilot programs rarely scale. So is venture capital even the right tool for this problem? In this conversation, we're challenging both sides. For real estate leaders, why innovation adoption is still so broken, and for clean tech founders, what does it actually take to raise capital and break into real estate? This is The Future We Build. I'm Alex Eds. Let's get into it. Thank you for joining me on The Future We Build. Really happy to have you, Rahul. So, we were just talking then just before we started. I guess just to sort of set the context of why I was really keen to talk to you is, real estate is often sort of painted with the brush of it doesn't innovate enough, it's not quick enough.
Yeah.
Obviously there's some huge challenges, not least the climate challenge, and there's so much that's the potential for the industry to kind of help solve or at least be part of that journey. And I've watched from the outside, obviously met Meatal probably 5 or 6 years ago now, and I remember just the inspiration that I sort of got from him around his view, and I was like, well, here's someone who's very different, here's someone in real estate that's doing things differently, and obviously what you guys have gone on to do since then is really, I think, inspiring, and it's a bit of a role model, which I think we're lacking so many in real estate, of like actually point to who's doing something different. So first and foremost, I think just from the outside at least, and I'm hoping you're going to tell me at the end of by the end of this that it is I'm justified in this, that it looks like you guys are just doing it differently, and you're doing it in a way which is much more strategic in sort of bringing I guess some of the problems and the solutions together. And so that's really where I guess I want to start is, a little bit about you, obviously, and just kind of how you found your way. And I know, looked in your background, that you obviously come from a sort of banking background. So kind of how you found your way to this, what you think of real estate now, or at least the prop tech real estate kind of sector as a marketplace, and a little bit about kind of 2150 and its journey to sort of become part of the Urban Partners platform.
All right. Well, thanks for inviting me on,
Of course.
So I'll tell you a little bit about my background initially, because I do come from a very different environment. I started my career at Goldman doing derivatives trading in equities.
It's very different, yeah.
And I did that for about 8 years. And then I actually loved it. I worked with some fantastic people, really smart people, enjoyed what I was doing, but it was also a very different business to what I wanted to do long term, which was work at the forefront of innovation. And so when the opportunity came up to join a venture capital fund called Global Founders Capital at the time, I really liked the idea of kind of combining a lot of what I had learned. We had been looking at Goldman at all of the kind of technology innovations that were coming into the trading market.
Right.
Things like at the time, crypto, blockchain, machine learning, a lot of those technologies that were coming into the market. But I just wanted to be much closer to the innovation side, and maybe a little bit further away from like the day-to-day trading aspect, and thinking much more long term. And so I joined initially Global Founders Capital, initially as a fintech investor, and then the fund was a large kind of stage and sector agnostic fund, so I got the opportunity to do a lot of things. We did a lot of consumer technologies, mobile, marketplace, kind of lots of apps that at the time, there were many apps that were being created in 2014, 2015 that were trying to become the Uber of everything.
Of course.
And you probably remember that. And so we did a number of investments in that area. And so that was my kind of entry point into VC.
How many of them still exist? Do you know?
Yeah, some of them. I look. The main issue with that was last mile logistics was always hard, and that's always always been the biggest challenge with these companies, that there's a big operational challenge. To get the unit economics to work on a last mile delivery product, you need huge amounts of order density and big scale. And so it worked with companies like Uber Eats and Deliveroo and Postmates and those types of companies that were doing food delivery. It worked with some of the others, but then like when you looked at like individual applications like like laundry, it's just very difficult to get the density and to make the unit economics work and the scale. And so those types of businesses were challenging. But we went through kind of that wave of innovation, and I had some of my own ideas. I decided to leave and start my own company, and I ran that for about 4.5 years. That was actually a food tech company.
All right.
And then we exited that. We sold that to a competitor, and I happened to meet Meatal.
Right.
And Meatal was the founder of Urban Partners. At the time, it was called NREP. He'd been running that business as a real estate business, trying to build a sustainable real estate business that was doing things very differently to the rest of the market, but still delivering outsized returns for the market and doing phenomenally well.
It's the Holy Grail, right?
Yeah, he was doing really great and continues to do so. And then had this idea that, as you mentioned, real estate has been a laggard sector in terms of technology adoption and innovation for, historically, right? It's forever. It's been a really kind of tech laggard. And why is that? And we were kind of looking into why that problem exists, and it's mainly because it's a multi-stakeholder problem. With other industries, you typically have one or two stakeholders that can choose to make decisions and then implement them. Whereas with real estate, you're working with governments, you're working with corporates, you're working with landlords and property owners, and you're working with tenants. And so it's just a multi-stakeholder issue, and it's very difficult to get everyone aligned all the time in order to adopt new technologies. Yeah. And so Meatal was trying to build a business that was doing something very different in that respect, and was really innovating the real estate product, and then started thinking about, okay, well, how do we get closer to innovation? Venture capital. Venture capital is investing in early stage technologies that can help businesses become more efficient and more innovative in the real estate space. And they decided that they might want to back, an up and coming player. And that's when the idea of 2150 initially originated. And then we broadened that theme quite significantly, because we started thinking about this as not necessarily like a real estate or a prop tech problem, but actually more of an urban tech built environment problem. So, rather than buildings, we thought about cities. Cities are the place where, we have, citizens in cities are more prosperous than those living outside of cities. They're better educated, they typically live longer, they have better health, but also cities are typically very bad for the environment. Consume huge amounts of energy, huge amounts of waste. And so if you can think about the problem of cities, how to make them more sustainable over time as we go through this big wave of urbanization that's happening. And when you look at the numbers, it's kind of shocking. It's like we're going from 50 to 70% of all people living in cities over the next 25 years. And throughout that time, we need 2 billion new homes being built. So there's just so much construction that's going to happen in that. There's so much energy demand that's going to happen. And so it's really important that we make those cities sustainable, because otherwise there won't be a way for them to exist and for people to have the quality of life that they do now. And so that's where the thinking behind 2150 originated. And there was actually a huge gap in the market in that sector as well. When we looked at the themes around sustainability investing and climate investing at the time, because this was really like climate tech 1.0 in 2020, we found that most of the capital, venture capital dollars, were going into the energy sector and were going into mobility, particularly micro-mobility. Right. You remember like all of the electric scooters and all of the micro-mobility businesses that were at the time attracting billions of dollars in venture capital. And built environment and industry were almost nowhere. They were not seeing much investment in terms of venture capital. And so we saw a big gap in the market, a big funding gap, but also a gap for new businesses to come in. And that wouldn't happen unless there was capital to help fund them at early stages. And so that's what the platform of 2150 launched on the back of that idea. And we brought together 4 partners to run that business. Jacob Bro, who I'd worked with before at my previous fund, Christian Yolk, who worked previously with Meatal and Urban Partners, at the time NREP, and then Christian Hernandez, who had been previously at White Star Capital and had founded that business and was then on Fund 3 and decided he wanted to do something more impactful and really liked the mission that we were on. So that's how we started. Amazing. The kind of origin story.
That's super interesting.
Yeah.
I've got a question there about sort of hardware, software, which maybe we can come on to. But
yeah, of course.
I've just seen in the news, right? You've just raised a second fund. Is that right?
Yes. Yeah. So fast forward 6 years. Right. We've just raised second fund. We have 500 million in AUM now. We're investing out of that second fund. We've done 5 deals so far. We expect to do around 20 again. So we fully deployed Fund 1.
Right.
We're still continuing to back some of the businesses that we invested in from Fund 1.
So follow on, okay.
But that's fully deployed now.
So maybe let's get to that, because and this is not seed round. This is sort of A, B.
Yes. Yeah. So we typically invest in Series A and B. We tend to have a little bit of flexibility in terms of how we operate. If we find fantastic entrepreneurs that we think we can add some specific value, and it's differentiated, then we can do seed.
Right.
But typically, where we come in is we like to take more execution risk and market risk rather than technology risk from the from a product perspective.
Okay.
So we like the technology part to be de-risked in the sense that there's some sense of product market fit. Companies have customers. They have some sense of commercial traction.
Okay.
But we can see if founders are executing well, and we can help kind of accelerate that process. And
that's interesting, because just to sort of draw parallels, and actually the timings are sort of similar-ish. And I forget when I met Meatal first, but it was probably around 2020, 2021. I'd been in the sort of post for about 5 years in an innovation role at JLL, and in that time JLL had launched JLL Spark. Obviously it's VC, but that, alongside a host of others in the sort of classic sort of prop tech space, were very much focused on SaaS. Right, it was basically software. And it was also it could have been early stage as well. And the sort of classic VC model of that. And I guess bringing it to you guys, I suppose, question, but there's 100% right. There's an opportunity for software, and certainly within real estate, a lot of the workflow, both in asset and within business, there's a huge amount of efficiency to be gained there. But it always struck me that if we're going to solve some of these big problems, certainly at a city level, we're going to need hardware. We're going to need we're going to need bricks and mortar. And so I'm curious, but that's more expensive, and VCs tend to be like, oh, that's too expensive. Don't like that. Can't get 10x on that. Do you go into that space? You kind of feel like you have to if that's your mission. So how do you kind of look at that within the sort of lens, but still having a lens of a VC?
So we've taken it on a portfolio level. So we like software businesses, but we also think that you need to invest in real assets in order to have meaningful impact long term. And by impact, I also mean kind of commercial traction and ability to build big businesses. Because the interesting thing is that SaaS businesses, yes, they're lower capex, but they require significant marketing dollars in order to expand into big businesses. And then even at scale, they tend to be in a very competitive landscape no matter what you're doing. So the nice thing about SaaS and software companies is that you get traction quite early. And so you can invest at Series A in a company that's already turning over a few million and can continue to grow, and you could see that growth quite quickly. So that's a great thing, and we like to have that in the portfolio. But long term, hardware businesses build competitive moats. And so hardware businesses can become huge businesses without a huge amount of competition long term and capture big market share. And so if you're willing to be a little bit more patient, it's not going to be a deal that you can flip in and out in 5 to 7 years. Potentially it's going to be 10 years, right? Could be 12 years. But if you're willing to be a bit patient, then we think that there are huge opportunities to build big businesses in the hardware space. And you can look at all of the kind of the winners that have happened over the years, and Elon Musk is building a bunch of hardware businesses and been tremendously successful, and everyone is trying to replicate that in this space. And we think that it's possible in many different sectors to be able to do that. And so the way we've decided to operate is to have a diversified portfolio so that we can have potentially the opportunity to find winners across both segments: software, hardware, and in some cases software enabled hardware as well, where there's a combination of let's say let's say just as a simple example,
give us some
you're
examples.
doing battery deployment, but you're also doing technology that enables you to do hybrid electrification of certain sectors, right? And that is managing a network of batteries, operating them efficiently, and being able to create great efficiencies that way. That's a kind of a software-enabled business, if you like.
In a funny sort of way, there's just thinking from a real estate handler, there's a sort of equivalent to that, which is the sort of propco-opco model in real estate.
Exactly.
Yeah. We've got the hardware, we've got the asset, and now we need to stick an efficient operating model on top of it.
Yeah.
Which is kind
and
of
we're seeing that in lots of sectors. Like there's this big wave of electrification happening in mobility, where various assets, like we've seen it in passenger vehicles. We're starting to now see it in delivery vehicles. We're seeing it now also coming into freight and trucking, where the operating margins are much higher with electric vehicles if you can solve the charging infrastructure problem. And so to get adoption is very difficult for operators to run mixed fleets. So if you run a fleet of, let's say, ICE vehicles, adding 1 or 2 electric trucks is not going to help you, because firstly there's a large capex investment to do that. They're a little bit more expensive. There's the charging infrastructure you need to build, and then you have 2 types of fueling infrastructure, if you like.
Of course. Yeah.
And so the propco-opco model is actually working really well. You build like a asset company that manages those assets, and then is able to, we're seeing this in that market, with is able to then work with logistics companies to be able to either lease them the electrification of their portfolio, or be able to service them in other ways.
So I've got a question on that, because one of the sort of hypotheses that we had at LaSalle was, certainly on industrial logistics, where you've got a lot of trucks coming in from a logistics perspective. It could also work maybe in retail.
Yeah.
Is that truck comes in, it's stationary for half an hour, whatever it is obviously then to use the infrastructure of that location to charge the vehicle, and then what better way to serve it is then renewable power from the site. Now, obviously, that's a sort of holy grail. How much solar can you actually generate? All this sort of stuff.
Yeah.
But I'm just curious to know. I mean, that, and certainly some of the companies that we spoke to, that was a great hypothesis, and it was like, we could. But obviously, there's quite a lot of dependencies before you get. I'm just curious to know how you're seeing that.
So we're seeing that. I mean, we've got a fantastic company in our portfolio in Fund 1 called Ember, which is doing that in intercity bus transport. Right. Where if you look at the other companies out there that have built decent-sized businesses in the UK, for example, like Stagecoach as an example, or Megabus and others, they have large fleets of diesel buses. And again, like going back to what we said before, adding a few electric vehicles does not improve the operational efficiency of your fleet overall. Because you already have a fixed bus depot, and then suddenly need to incorporate charging infrastructure. And what Ember is doing is building this from the ground up as a electric bus business. Right. And so what they've done is they've built charging hubs for their buses. They've put electric buses on the road, various routes that they've launched. They launched in Scotland. They've have a incredible customer first attitude and business model, such that what they're doing is kind of very different to your typical model. They do very little in terms of kind of marketing, but their business is growing incredibly fast, and they have beautiful buses on the road. They have great kind of charging infrastructure which they've built, which is run through solar and wind, and they're able to kind of generate great customer traction by having just a great
better
product.
experience.
Just a really nice customer experience.
I mean, it's a classic example of another industry where it's not that difficult to improve the customer experience, right? Yeah. Just do it slightly better.
We actually quite like that idea of just taking these massive markets that haven't really innovated much and just do it a little bit better. Actually, Meatal has said this for many years. Like, real estate is a perfect example of that. Wow. Like, you can do it better, and you can still see decent returns. And we're doing the same here, and we're also looking at the kind of logistics and freight market as well in the same way, where we think there's the possibility of again building a vertically integrated player from the ground up, and then eventually they can expand through franchising deals or licensing deals and kind of deploy the operating platform. But in the short term, you really need to build the infrastructure.
So let me just ask you then, because I guess the bus example is a good example of that. Do you prefer then that sort of full vertically integrated hardware software, to use that analogy, like we can come in and we will completely displace what was there before? But I'm hearing by the sounds of it, that's the model that you like. That's obviously A, more expensive, and B, it's the route to market and scale it, I guess, is you're dealing with quite a lot of incumbents to challenge, versus, and to use the bus analogy, rather than, let's say, investing in a EV charging company that can just come and start putting solar panels on the roof of the existing charging network. You would rather, do you know what, we want to go whole hog, let's disrupt the whole thing.
So it depends on the market, and we've seen both work, and it goes back to what we were saying before, which is that the software company that's doing EV charging technology is going to see lots of competition in that market. There are lots of companies that are going to do the same thing. And so if you've got a great product and you can execute very well, and we see that they're moving very quickly, then great, let's back one of those as well. But let's have in our view, like a more balanced portfolio where you could have some, big disruptors that, yes, today they need a bit more capex investment, but actually, and this company that we invest in, Fund 1, Ember, has demonstrated that actually you can have really big market traction as well that way by just improving the customer experience as well.
Okay.
So we like both.
Maybe then, just be curious to know kind of we talked about sort of mobility, but are there other, if you've got, sort of share what you don't want to share, but are there any kind of other hypotheses around, particularly, I guess, real estate more generally, built environment, where you think, or where you're already seeing, I guess, that sort of disruption from a sort of full vertical integration? Are there things that you're seeing already, or that's catching your eye, or that you want to see and want to invest in?
Yeah, so one of the things that we've been looking out for many years is the right types of businesses in kind of building automation. So, there are a lot of building management systems that we've seen over the years. I'm sure you've seen many in your time, right? And also, energy management systems, and one incredibly competitive market because it's so difficult to differentiate yourself as a company in that space. And two, the customers are pretty tricky, right? You want to win, the big landmark customers, and everybody is going after them.
And they're not. And sorry to interrupt, but the product itself is not sticky, right? You can put it in and you can take it out, which is part of the sales pitch. Is it's really easy to put in, but then it's also easy to take out, which is from an investment perspective is challenging. So
so that's a market where you can see the same thing, which is that if you're Urban Partners and you're deploying capital and you're building real estate. Then you could do that in terms of a kind of a vertically integrated way, using the technology from the outset and building with that in mind. And so that's a model where when we see it, and Urban Partners is kind of doing this already, where we see that potential. And it's also one where at 2150 we've not yet found the business there in that space that we think is kind of the proven winner long term. And we've been tracking many of these companies over the years, and we find it's quite difficult to kind of break out beyond, let's say, like the 10 million ARR. Like we say, like the journey from 1 to 10 is doable for many companies, and then kind of the journey from 10 to 50 is very, very tough.
That's interesting.
And so we haven't seen many in that space.
Okay. You sort of touched on it there, but I think what intrigues me about your model versus, let's say, there's obviously, I'm not going to name any names, but there's a host of other, I guess, VC funds out there, both from a pure prop tech play, climate tech, build environment, whatever. What do you think? And I'm curious to know, kind of, does it exist? But if it does, kind of, what do you think is the value for you guys sitting in the VC seat by having the kind of NREP portfolio as your kind of sister company? Like, is there, is it symbiotic? Are there opportunities to test and learn? I'm guessing you're getting intelligence back from them. Just curious to kind of know how does that actually work in practice? From the outside, again, it's like, thumbs up, that looks really like a good idea. Does it actually work in practice? So there are some cases where there's obvious synergies, right? So if we're looking at, built environment software, of course, it's quite easy for us to now say, hey, let's go to the real estate portfolio that we have within Urban Partners, go to the people managing that and say, hey, would you use this, right? And Urban Partners is also
innovating a lot in terms of how it thinks about its own direction in real estate. So it's thinking about, behind the meter energy generation on site. It's thinking about, logistics and how that is how that whole market is evolving with the electrification of the fleets that we're seeing in that space. It's thinking about kind of data center deployment and the real estate that around data centers, particularly both at the edge and co-located. So there already a lot of innovation happening there where we can add some value because we're seeing technology companies that are helping to operate those those assets. So I think on that front, it's a kind of a nice two-way relationship in terms of helping us diligence companies that we might look at, as a potential customer, and helping the Urban Partners real estate portfolio also think about the type of technology it wants to build into its real estate portfolio over time. So there, it's interesting. Where we've seen less adoption early on that we would have liked to have seen much more is that. When we were looking at a bunch of frontier technologies, like new building materials, for example, we found the reality is that you just need to be at a certain scale before you can get to the kind of unit economics or the cost metrics that make it on par with any traditional construction material. And Urban Partners is not going to deploy new technologies just because they're more sustainable. They're going to deploy new technologies because they're sustainable and cost efficient, right? And so they're thinking about, and that's a good thing because those technologies need to get to a certain scale before they can be deployed more widely. And in order to get to that scale, they need to have various kind of going through a various testing process. And at Urban Partners, we've been supporting with that testing process. So a number of our portfolio companies from Fund 1, where we invested in, for example, new types of building materials, we were able to test them out within the real estate portfolio of Urban Partners, which was incredibly helpful to those companies, right? Because otherwise they wouldn't have had that opportunity to kind of trial and see what went well, see what went wrong, and kind of iterate on the product, which I think is really necessary.
I mean, again, from the outside, that's the obvious kind of. I mean, certainly from a founder's perspective, but also just generally in terms of a systems market, like how do we get the market moving is that, right? Well, we've got the money to invest in you. We've also got a portfolio where you can test it. But often I hear the sort of barriers, well, we can't because, as you say, we've got to make the decisions for these reasons, and we can't sort of muddy the water just because our sister company is investing in something. So I mean, we very specifically, are very conscious about that, right? And, as partners in 2150, we're also partners in Urban Partners overall. And so we're thinking about the kind of business as a whole. We don't just deploy something because we're invested. It will get deployed and it will be looked at alongside all of the other businesses in that space, only if it makes sense. I mean, and it comes back to your hardware software point, right? Is that it's so much easier to scale the software, and I guess something that I just can't. It's like, I mean, you said it then, is the company needs to get to a certain level of scale before it's then it's like, okay, but how do we get it to the scale? Like that seems certainly from a hardware perspective company or a materials company, it's just there's such a
and there's a couple of things there. One is, for the unit economics to work, both for the company and for its customers, it needs to be at a certain scale anyway, so it can make the supply chain efficient. But it also, the product needs to be able to be demonstrated to work, and that first part you can only do if you've got a willing counterparty to test it with. So that's very helpful. But the second part only comes when you have the metrics to be able to demonstrate and say, hey, look, actually it works, right? We invested in a company called Lux Well, which is doing next generation windows. They do vacuum insulated glass, but it's incredibly energy efficient. And the industry for adoption, when you look at the industry and how they kind of adopt new window technology, you can probably imagine that it's a tough sell to put new like a completely new type of window product into a building, either a new building or even a retrofit, just because the way these things are looked at is kind of in a pretty traditional way, and there is a standard supply chain. And so if you have a business that's like Lux Well that was able to demonstrate how their product is so much more efficient, and once it was able to do that, then the adoption comes,
You've almost got to be so much better than the incumbent. Because if you're just a little bit better, it's like, well, it's just too much pain.
It's not enough.
And I guess also things like insurance and now fire, particularly in the UK, things like material-wise, there's so many hoops to jump through. But it's interesting because the sort of, like I'm sure a lot of us, and I'm sure certainly you do, but I get approached by a lot of founders that they come to me at their seed stage, they've got an idea, but it's a hardware idea. It's a big idea, and it's like this is going to take some serious capital to even get past stage one. Yeah. And then I'll send it on to some of my VC kind of like won't touch that, and so I'm just curious to know, like, what would be your advice to, because we need entrepreneurship, we need innovation, we need smart people coming up with new ideas about how do we change fundamentally the fabric of our built environment.
Yeah. I think
what's your message to those sort of founders? How do they get to the point where coming in to speak to you, it's like, okay, great, we're now at whatever the stage is, we've got the revenue, we've proven it, and we're willing to back you. Kind of how do they go from zero to there?
Yeah, so that's a great question, because I think that demonstrates that there is a certain funding gap there. And the reason that funding gap is there is because the VC model needs to work in a certain way, which is that VCs need to be able to, typically if you think about portfolio construction, we have 20 to 25 companies in a Series A portfolio. And there's a power law model, which is that typically VCs see the majority of their returns, 80% plus of their returns, from less than 20% of their portfolio. And so you expect, and the way you think about investing is, in venture capital is that you expect that there will be a number of companies that don't make it, and that those that do deliver outsized returns to be able to mask any of those losses. And that's, in a way, one of the nice things about VC, which is that you can only
be wrong 80% of the time.
you can only lose 1x your investment, but you can make an unlimited x. And so the interesting thing there is that you're looking for businesses that can turn whatever you're investing as a first check, 5 million, 10 million, into potentially 500 million or a billion, right? And those are those outlier cases that you're looking at. And so when someone comes along that says, hey, I need this amount of CapEx, I need this amount of R&D spend in order to just get the thing running, then you realize that actually as a VC, that model might not work, because there's so much risk that at that stage, you don't have the commercial traction that it might not work. And so that there's a big risk that it may not work out. And so that's why typically VCs are looking for, at various stages, right? Like at Series A, you're looking for, some sense of product market fit, and, you want to be able to scale from there. At, seed or pre-seed, you're looking for, a great market opportunity, a huge TAM, a fantastic idea, phenomenal entrepreneur that really is really compelling and is able to build this business. And so I think, and we believe actually, that there's a funding gap beyond that, and there's capital that's required beyond venture capital for these types of businesses, and it's somewhat of a credit product that doesn't really exist today.
Right.
There are obviously venture debt products out there, but venture debt typically firstly comes alongside equity, and it secondly is, the mandate is slightly more risk averse than venture anyway, and so typically they'll invest when they also see customer traction. And so we believe that there is an opportunity for an earlier stage credit product that could support some of that strategy of kind of getting from a idea to a business, right? That could then attract venture capital.
It's funny because we had another guest I had on with another episode. We were talking about kind of AI and data centers and the speed at which that market needs to move. And it's interesting because you've effectively got the big Silicon Valley companies used to doing software, used to doing chips and software coding. Their limiting factor now on their speed of growth is hardware, and it's built environment. Effectively, it's data centers and it's resources. And
energy.
And one of the things that we were sort of hypothesizing was, well, if real estate for the last 100 years or so hasn't been able to sort of sort itself out in the context of what you're saying, which is to properly invest in, software's kind of being done through the VC model, but as you say, that sort of complex hardware piece, which, let's be honest, is the bricks and mortar of the building. maybe it's going to be the companies now, the richest companies in the world with the deepest pockets, saying, well, we have to solve that because we need to deploy X number of data centers at this much speed, at this much time, to be super efficient, the lightweight materials, everything that we've sort of are trying to do. I mean, I appreciate it's kind of one box of a product, but whether or not actually in a way that the real innovation might come from the least expected source.
Yeah. And I think, and if you listen to all of the commentary that's out there, I think that people are already thinking also beyond that, in the sense that they're thinking about the fact that if you look at the resources that are being required for data centers, for example, today data centers take up about, I think, 1.5% to 2% of electricity demand. The expectation is that in only 5 or 6 years, it could be 25 to 30% of global electricity demand. Yeah. And that's not going to be possible. Yeah. Like the grid infrastructure won't support it, and where will the rest of us get our energy from? And so the opportunity set is there, right? Like we have the possibility of integrating a lot of renewable energy into the system, but there's a lot of things that are required for that to happen, like all the permitting that enables that to happen, the funding that enables that to get built, the process around kind of building that infrastructure, and that will just take a long time, and it will potentially take too long before it's kind of required. And that's why we're also seeing a lot of talk around, like, can we build orbital data centers where
on the moon, right?
Can we build data centers on the moon? Can we build data centers in space where there's access to potentially unlimited solar energy? There are lots of other issues.
Quite getting there.
How do you get there? How do you manage all the heat that's generated from these these units? But I mean, there's it's a fascinating.
Well, it comes back to the point where the brightest people in the world, probably now, or a lot of them anyway, are working for these companies. Yeah. They've got unlimited resources to solve these problems. So maybe we will start to see some real, true innovation in how do we extract things from also things like recycling of precious metals and things like that, right? There's so much of that in landfill. How do we get that out? No one else has been really the cost, the unit economics hasn't been there to kind of justify that. So
and actually, that's an interesting AI application that we've seen from one of our companies. We invested in a company called Meatal, which is doing secondary metals trading, scrap metal trading, and that it's a huge market. In fact, I was surprised at how many hundreds of billions of dollars that market was. Just the trading of scrap aluminium and scrap copper. And the problem in that market is that most of this is basically recycled and then smelted and then downcycled, i.e., your scrap aluminium that might come from a car will then be used for something that wouldn't typically be used in primary production. So it won't be used to build another car. It'll be used to build, let's say, like Coke cans, right? And so how do you get that secondary metal? How do you build it up into primary grade? And if you could, then you could potentially have unlimited recycling of metals. Which would be a complete game changer for the industry. And this is actually an AI application, because one of our companies has found that by doing smart sorting, there are kind of 300 grades of aluminium, for example. By doing smart sorting, by using all of the data that gets generated by recycling centers, you can sort those different grades of aluminium in an efficient and effective way using AI. And once you can do that, then you could potentially have primary grade aluminium eventually from secondary metal. And that that could be really kind of a game changer for the industry.
You're touching there on circular. I think for me, certainly within the context of the built environment, buildings stand for 50, 100 years. And there's modular, maybe we're building things for disassembly. I'm just curious to know, and are you seeing any companies that are really kind of cracking that sort of circular piece? I mean, you've mentioned one there around metals, but that could extend through, the whole value chain of buildings. We've seen examples of building passports, but again, that's almost like a software problem, a software solution to a hardware problem. Curious to know.
No, so this is a great question, because we love this type of
Someone's
of innovation.
got to crack this, right? Yeah.
And we've been looking for years for companies that can do this effectively.
Well, if anyone's listening.
And, and the challenge is, and we've seen some great businesses and great entrepreneurs that are trying to innovate. Yeah. And actually the material passporting helps, because when you have a clear digital inventory of all of the building materials, then you can do something with it, right? So you need to be able to understand what you have before you can figure out if you can trade it. So that has helped the market. The biggest problem is that this is just a hyper-local problem, and that's very difficult to scale. So for example, we saw a business that was effectively looking at buildings that were marked for demolition, and then going in and taking a digital inventory of all of the building materials that were there, and then figuring out the fact that because these materials had to be then disposed of, and so the company that's dealing with the demolition will have to pay to be able to get rid of these materials, then there's for a software company, a huge take rate available, because if you can find a value in these materials, then you can take the majority of it, because actually you're saving someone from having to pay to dispose of it. And so we really like the idea of being able to do that. The problem was that it requires hyperlocal demand and supply. So where you're taking the demolition, where you're taking the materials out of demolition, you need to be able to sell them there, because otherwise the cost of logistics just outweighs the cost of the benefit from being able to use these recycled materials. And so I think it's partly a logistics challenge that's very difficult to solve. And as you say, it goes back to being a hardware problem, because the software solution is there. There is actually an interesting AI application there, which is that if you had a clear line of sight on digital inventory of all the data of all the demolition that's happening in a certain area, then you could probably bring demand there if you knew also all of the purchases of those materials that were happening in that area as well. And so that, I think, is an interesting AI application. If anyone's building that, then we would be.
Well, there you go. I mean, one of the questions I asked all my guests is like, what problem would you like seeing solved? And by the sounds of it, I mean, because so if anyone's listening out there and they want to try and crack it, go for it. But it also comes back to, I suppose, this paradox, particularly of AI, of the environmental and social kind of costs of certainly the data center piece of it, but then the opportunity of AI as a tool to help us solve some of these problems. And you've mentioned it a few times now, that AI is already starting to unlock and should be able to unlock some of these key challenges that just we haven't been able to unlock.
So it goes back to your first question, which is about climate tech. So we see climate tech now as being a subset of applied AI, effectively.
Right. Yeah.
Which is that, like, the way we've seen this market move. I mean, it's funny because it's only been 6 years since we launched 2150. In that time, I think climate tech as a sector and a market has changed 3 times. Climate tech 1.0 was demonstrating that renewable technologies like solar, wind, EVs, batteries, that they actually worked, and that the unit economics stacked up, and they were able to demonstrate that. And then climate tech 2.0 was starting to look at the hard-to-abate sectors where electrification alone wasn't enough. So, cement, steel, aviation, agriculture. There you needed different types of solutions, right? And, we've looked at alternative proteins, we've looked at green hydrogen, we've looked at sustainable aviation fuel. And the challenge there is that many of those technologies were not able to get to a scale where they became cost-effective to use them. So they required either government incentives or a green premium. So companies buying them because they were more, climate positive.
Which is just challenging, certainly in this market.
And that changed, right? That market changed. And so a lot of those businesses have, so far still trying to find the way to scale. And now we're at kind of what we think of as climate 3.0, which is that now with the new wave of AI, we're seeing climate as an application of AI, right? We're seeing that, can you do predictive maintenance? Can you think about, managing the supply chain in a more effective way? How do you think about, managing the fallout of wildfires and predictive analytics around weather forecasting and things like that. All of these are AI problems that can now be solved much more effectively than they could 10 years ago.
Mad, isn't it? I mean, probably even 5 years ago.
Yeah.
It's just that so much has changed just with that. Now I think also people's minds have been unlocked, even like there's the possibilities of what it can do.
Yeah.
So, we can actually have a go at cracking that. Yeah.
Yeah. And for us as a venture fund, by the way, this is like broadens our opportunity set massively. So this is very exciting.
I'm guessing a lot of what you're seeing come through is AI based now. I mean, it's going to be right. Yeah. One question I ask all my guests, I mean, we sort of talked about one of the problems that you'd like solved. I'm just curious though, are there any other areas where, you're really looking at the moment as part of your thesis for founders or for companies? Is there any particular area that you're really excited about?
I mean, we've done a number of investments in residential energy because we saw and we still see that as a market. I mean, I said at the beginning, 2 billion new homes built over the next 25 years means we're going to have huge demand from residential property in terms of energy. We see the same opportunity in CNI energy. We see the same opportunity for corporates procuring energy in a more effective way. And right now the system is kind of broken in the sense that you have all these generators that are selling to utilities that are selling through brokers to corporates, and there's so much kind of fat or margin in between because there are so many people within that chain. Why not the generators find a way to sell directly to the corporates? And so that's an area where we're spending quite a lot of time.
I mean, funny, I know of some guys out there that are really looking at the flex market of energy, being able to buy and sell and that sort of marketplace piece. And I mean, it takes a bit of a leap of faith. Well, not a leap of faith, but there's an element of like, well, we need a bit of a critical mass to get there. But once you're there, you can totally see, like, okay, this has just got to be the way forward, right?
Agree, and it's such a huge market that's ripe for disruption.
Wave a magic wand. Is there anything that you would ask of government, businesses out there, and I guess maybe when I say businesses, the customers of your portfolio companies, or maybe individuals, but just curious to know if there's anything that is kind of really holding things up, or that you would like to see either government and or businesses do differently. If there's one thing that you could get them to do differently, what would it be? So
businesses need certainty, and what helps in terms of where business can invest, what helps is to have a clear view on what government policy will be. And the biggest challenge that we have, and I think particularly in the UK, is that government policy changes all the time. They put targets in place for new EV adoption for passenger vehicles, and then change those targets. Targets in place for when gas boilers will be ruled out. Those targets were changed, and so it's very difficult especially for startups, right, to make decisions around what's the right business model for them if the government keeps changing its policy around these types of areas. So that's one thing. If I could wave a magic wand, I would like the government to take a view and then stick to that view.
It's funny. I mean, here's a hard-nosed, I'm not calling you this, but like a hard-nosed financier saying we need better government. Because one of the things, and I have friends or associates that say, I sort of get challenged on this, is the sort of politics sort of coming into some of these things, particularly sustainability, and it's like, oh yeah, but that's why we're going to pull back on this, or but people can't afford that, and but you don't realise that what we need to do and what government's role is for this. And I appreciate sometimes we need to pull government back and things like that, but one of the things it can do is be a catalyst for innovation. And if you can just set a marker in the sand but don't move it, let capital markets come in.
Agree.
And I think a lot of people don't fully understand that, when they just see, Prime Minister or whomever sort of standing up and going, well, this is what we want to do, and it's but that's going to cost more. That's a signal to the market, and the market needs that. Certainly when it's in terms of like new technologies, new ideas, and as you mentioned, like for you guys as VCs and the rest of the financing community, is we're only going to back that if we know that that's the way the market's going to go.
I mean, private and public markets are very good at allocating capital to the best, to the areas that can be the
and if there's a market there, we know there's going to be a market there. Agreed. Thank you. Really, really good chat, and I learn a lot, and I think hopefully my listeners learn a lot. In terms of the sort of arc of this season of I've sort of been speaking to people that are investing into real estate, been speaking to real estate people, been speaking to suppliers, but I think having the lens of someone who's investing into the suppliers of real estate and kind of what you're looking for, and I think certainly what I thought about Urban Partners and 2150, you've kind of confirmed that you guys are doing it a bit different, but you seem to be doing it well. So yeah, thank you.
Thank you very much.
Cheers.
Thanks for having me.
Rahul. That's it for this week's episode of The Future We Build. I want to thank you so much for listening to us wherever you are. If you're navigating these same challenges, from pricing in climate risk, decarbonising buildings, or if you're scaling a new product or solution, join us on LinkedIn. Search for me, Alex Eds, or follow our official page at The Future We Build. That's where we break down these episodes further, discuss the topics and discussions, and connect you to the leaders engaged in this mission. This show and the guests I invite will be influenced by the conversations we have on LinkedIn. So if you have ideas or would like to hear the thoughts of an industry leader, let me know, and I look forward to continuing the conversation with you there. You can find the show notes and full transcripts on our website. And if you found today's session valuable, please hit subscribe on Apple, Spotify, or wherever you find your podcasts. Thank you for listening. I'm Alex Eds, and I'll see you next time.